What's a fund?
I'd actually compare it to almost like an allotment. Lots of investors pool their money into one kind of allotment or garden, and they hire a head gardener, effectively.
What does a normal day look like for a fund manager? And as per the movies, are you there running around with bits of paper and slamming down phones, shouting buy, and sell on behalf of clients?
So it's not quite as exciting as in the movies.
So give me an example of the types of decisions that are being made day to day.
You're not in control of geopolitics. You certainly aren't in control of what President Trump tweets. You're certainly not in control of what the European Union decides is going to be law. You're not in control of how the UK economy is going to behave. But you are in control of what assets you choose. You are in control of how diversified or how much the risk is spread in your portfolio. You are in control of how much you own of each different type of investment, and you are in control of how long you own that investment for.
How is that risk managed on behalf of a client?
First thing, we do really, really in-depth research so we truly understand what we own.
Which fund manager's got the biggest marrow in the contest is an entirely different podcast.
It is.
Welcome back, everybody, to the Funkle Pod, where we cover the money topics you didn't learn about in school with expert guests, and it's always jargon-free. Now, if you've ever invested money, maybe through your pension or an ISA, the chances are that someone somewhere is making decisions on your behalf. We're often told that our money is in a fund and that it's managed and that there's somebody looking after it. But what does that actually mean in practice? What does a fund manager do day to day? And what decisions are they really making? What decisions are they not making? Strip all of that back. I'm joined today by David Aujla. David's a fund manager at Invesco, big fund management company, where he makes investment decisions on behalf of clients, deciding where money goes, what risks are taken, and how a portfolio is positioned, what's being bought, what's being sold. So today we're going to lift the lid on what that job actually looks like. And we're going to bust some jargon along the way because we don't like jargon at Funkled. I'm going to help you understand what's really happening when your money is in a fund. David, welcome to the Funkled Pod.
Thank you so much, Dan. Thanks for the invitation. Delighted to be here.
Excellent. Let's get stuck in. What's a fund?
That is a great question. I think people often hear the word fund and either have no idea what it is, or maybe they have half an idea what it is and think it's, it's finance or money related. And maybe they'll think it's some mysterious box in the city where people are making lots of decisions and shouting buy and sell or doing something maybe clever or slightly scary and complex with people's hard-earned savings. Well, unfortunately, or actually fortunately, it's a lot more boring than that. I'd actually compare it to almost like an allotment. The allotments people get there, I think they call them community gardens in the US.
Go on, this will be good.
Imagine a big shared allotment, right? So you've got some people who like having their own plots. I think of those as the DIY investors, the people that have the time and inclination to read up on the soil, think about all the different planting schedules, which plants they want. They're happy to spend their weekends doing a bit of digging as well, out in the cold and all weathers. And there's others that like the idea of the fresh vegetables and need those fresh vegetables, but they don't really like the idea of effectively having a second, almost full-time job to do it. And I guess a fund is for the second group. Lots of investors pool their money into one kind of allotment or garden, and they hire a head gardener, effectively. And I guess I'm the head gardener. I will caveat now by saying I actually know relatively little about gardening in the real world and various plants and vegetables. But in the investment world, hopefully I know a little bit. But that's how I would equate it. It's, the idea of a fund is that you get access to a variety, in this case, of different vegetables, but of course in the real world of different investments, and that you're able to spread your risk across more than one thing. And it actually makes it easier for investors to access because they don't have to buy individual things. In a collection, in a basket. They can buy a unit of that allotment alongside other investors and get access to pretty much all of it.
Okay, so this is probably the first time that fund management's ever been equated to allotment keeping and to vegetables, which I'm a big fan of. So what actually goes on behind the scenes when, let's torture this analogy, somebody's coming along and saying, right, I want a little bit of that and I've got my money. It's in my ISA or my pension, and I'm going to put it in that fund. What's actually happening to that money behind the scenes? How is it pooled and used by you, the fund manager?
Of course, it depends what type of fund you invest in, but let's assume that it's a fund that spreads its risk across a broad range of different investments. So what is happening and what's not happening? So the first thing that shouldn't be happening is that you're effectively buying, to torture the analogy, one plant or vegetable, right? So immediately it's being spread across a range of different investments. And in my job, I'm what's called a multi-asset fund manager, which is a highly jargonistic or jargony term. And what that really means, multi-asset means different asset classes. So I'm investing, in my case, in other funds across the stock markets, the fixed income market. So that's bonds, both of governments and companies, and things like cash, and maybe some alternative investments. And I guess the one that's popular in the markets and you might have read about in the papers at the moment is gold. So when you buy a fund manager like me is already, hopefully, spreading the risk across all of those things. And to torture the allotment analogy, you want to make sure you have a prize tomato plant, a prize marrow plant, but you also want to make sure you have other things in there that aren't reliant and aren't all really going to grow at the same time or reliant on the same type of weather. And let me think about how I can explain the long-term nature of this, because it's not really about, who's got the biggest marrow for the show in the summer. This is a multi-year thing. We're trying to invest for the long term, and really we want to make that sort of spread of risk across all those different vegetables, but we want to keep the soil intact for the future generations so we can grow over the long term. I think we might be at the end of this analogy, but hopefully that gives you an idea of what a fund does.
Which fund manager's got the biggest marrow in the contest is an entirely different podcast.
It is.
Excellent. Right. Okay. We've got, through our allotment analogy, we've managed to work out what a fund is and how it's all working. What does a normal day look like for a fund manager? And as per the movies, are you there running around with bits of paper and slamming down phones, shouting buy, buy, and sell on behalf of clients?
Again, unfortunately not. If you watch things like The Big Short, The Wolf of Wall Street, I think they did certainly glamorize the finance industry, but even then they're normally talking about a part of the finance industry that isn't the asset management or investment management part that I'm in. So no red braces, striped shirts, no Gordon Gekko type behavior. There are actually, I was going to say no 6 screens, but in some cases you do have quite a few screens to have a look at things, but you certainly haven't got a couple of phones either side of your head shouting buy and sell. As I sort of alluded to earlier, we try and invest for the long term. So very rarely would we be making short-term decisions. Of course, if something happens in the world and markets that necessitate a change, then of course we'll do that. But really, day to day, you should have planted the sort of foundations of your long-term portfolio so that you don't need to make huge sort of course corrections. Day to day is a lot about monitoring the portfolio, monitoring what's going on in the world, a lot of deep reading, engaging with a lot of the underlying managers in which we invest. So that could be across different asset classes, as I explained before. So people that are experts in the UK market, the bond markets, and other markets around the world, to see, in comparison to my top-down view, my kind of bird's eye view of the world, their boots on the ground view, because they're, of course, experts in those individual markets. So often a lot of it is about marrying what I'm seeing with what they're seeing and making sure that our strategy is still appropriate to deliver what we need to deliver for investors. So it's not quite as exciting as in the movies, but I must say it is very intellectually stimulating. If you're interested in the world and how it works, it's an absolutely fantastic job to have.
So give me an example of the types of decisions that are being made day to day. I appreciate that this is long-term investing perspective you're talking about, but there's still sort of a continuous thought process and decision-making, even if that decision is to do nothing, that's happening day to day. So what are the types of things that a fund manager is thinking about day to day?
Right. So I guess each fund will inherently have some parameters around which within which you work, and largely those parameters are probably set by the amount of risk the investors in that fund are expected to take. So one of the decisions you take is like, what mix of assets can I deploy here or invest in here within that risk profile that's going to give us the best outcome, and ideally the best journey to that outcome over time. So that might be, how much do we have in stocks? How much do we have in bonds? And within that, what mix do we have? How much do we have in the US equity market? As you know, the US stock market is probably the one that gets all the headlines. It's got all those companies, the so-called Magnificent Seven. which is stolen, of course, from a great film back in the I think the 70s. Those tech and artificial intelligence themed companies. How much do we want in our own domestic stock market, the UK market, which tends to be more commodity, so oil price and mining dependent. And then in the fixed income market, it's very similar. How much do we want to lend to government bonds to earn a return on that in terms of the coupon, and how much to different companies that might be issuing their own debt? And so the decision there is really, how much risk do we want to take? Where do we want to take it? And then the other decision is, how do we want to take it? How do we want to access it? Do we want to access it by another fund, another ETF? Do we want those to be actively managed funds where fund managers are making active decisions that might be different to the overall market, or are we happy to take the broad market exposure? Those are the sorts of decisions we take on an ongoing basis. And of course, we're constantly meeting with other fund managers, in my case, to understand what they're doing. And obviously, we have a view on whether we agree with it or not. But I would say that we don't make more decisions than we make. And I think that's probably the right way around if we're going to have successful long-term outcomes.
You mentioned risk and the idea that you're managing risk continually based on what the fund's doing or what the fund's mandate is for how much risk it could take. So how is that risk managed on behalf of a client? Let's say there's a clear parameter of how much risk a fund should take on the one hand, and clients have invested in it because of that. So what does that mean for day-to-day decisions and thoughts from your perspective? Where do you start to think, right, we've got to move out of that and into that as a consequence? What are the things you're looking for?
So one of the things that I think permeates throughout our industry are the idea of risk models, and they're often backward-looking, models that try and inform the future. But I often think that, if you look too far back in the past, you might get a skewed view of what's happening going forward. So one of the key things.
So that's looking at how much things have gone up and down in the past, and then deciding actually that might happen again or it might not.
Exactly. A model will do that. And I guess my job is to understand whether I think that model is actually giving us a good sense of what might happen in the future. And a good example, the problem with some of these models is if something's being very unpredictable in the past, it will assume that it's going to be so going forward. And I guess one of my key jobs is to understand what the true risks in portfolios are. And there are lots of different ways of thinking about risk, right? So I think many of the people in the audience will be thinking about risk as, what are the chances I just don't get my money back? That's kind of your first thought about risk, and the one way you can think about that is by how do we address that risk? Well, first thing, we do really, really in-depth research so we truly understand what we own. Secondly, we think about something called valuation, and I guess everyone does that day to day when they're shopping and buying things. You think, actually, is the price I'm paying appropriate for what I'm getting? And ideally, it's appropriate, or ideally even cheaper, right? So the cheaper an asset is, as long as it's a decent quality asset, over time, hopefully you'll see some return from that asset. And then there's another way of thinking about risk, and it's something the industry calls volatility, and that's really how much the price of an asset moves around over time. And I guess, I'm not sure if this is a good analogy, but imagine going into a shop every single day and the price of a particular item on the shelf just happens to change price pretty wildly. I mean, that would be a high volatility investment. In this case, you'd be buying it, but in other cases, you might be selling it. And the higher the volatility is, or the more those prices, the more often they swing around, the longer a time horizon and an attitude, and the bigger an attitude to risk you really probably need to have if you're an investor in those types of assets. So I'm trying to make sure that the assets in a fund are appropriate for the type of risk that people are willing to take, whether that is how much a price moves around or the likelihood of getting their money back. What I would say about all the funds that we manage is, obviously, we want a pretty high likelihood of everyone getting their money back.
What things are inside your control and what's outside your control that often you think the general public might think it's the other way around?
That's a great question. I mean, there are certain things that are certainly not in our control, and that is what markets are doing and what presidents are going to do and how geopolitics evolves over time. And sometimes those things can have an impact on portfolios, and sometimes they're actually just noise and you need to look through them. Can I use the allotment analogy here? I would say if I could. I mean, what I'm not in control of with using the allotment analogy is I'm not in control.
I'd be disappointed if you didn't continue the allotment
Exactly.
analogy.
Well, I'll try my best, but we'll see where I get to with it. But I wouldn't be in control of the weather in that scenario. But what I would be in control of is making sure the soil's being fertilized properly, that we've put in a proper spread of different crops that aren't reliant on or aren't all going to grow in the same way at the same time. Some will be hardier to provide your portfolio in this sense with a bit more ballast, a bit more robustness, and some will be a bit more sensitive to the weather. So you know, hopefully you still get a good outcome from them, but you certainly wouldn't be relying heavily on those. They're the sort of, you'd be a smaller part of your portfolio. In fact, maybe I could switch to a pilot's analogy. I suppose my job is making sure we've chosen a good plane, we've done all the right checks, and we've got all the right equipment on board, we're fully fueled up, and when we're in the air, we make sensible decisions when there's a bit of turbulence. But I'm not in control of the turbulence, and I'm not in control of the weather, but I'm in control of those other things that I've mentioned there. And so in portfolios, you're not in control of geopolitics. You certainly aren't in control of what President Trump tweets. You're certainly not in control of what the European Union decides is going to be law. You're not in control of how the UK economy is going to behave. But you are in control of what assets you choose. You are in control of how diversified or how much the risk is spread in your portfolio. You are in control of how much you own of each different type of investment. And you are in control of how long you own that investment for.
I'm going to keep playing the game on this allotment because another part of the analogy that's come to me is what are the biggest risks that you are mitigating against, and how are you doing it? We've touched on, I think, some of them, and it may be that those are the ones, sort of diversification, for example. But with the allotment analogy, you would have some rabbit netting up, you'd have some bird netting there, you'd be controlling pests, etc. So what are the fund managers, rabbits, pests, and birds that you need to mitigate against?
I'll think of the allotment thing in the background while I'm answering the question in a more straightforward way. There are lots of things to think about, and particularly in my role as a multi-asset fund manager, where you're thinking across different markets and different asset classes all the time. And there's always, quite frankly, something to worry about. The benefit I have is that with that job and with the funds I manage, they are inherently spread across more things than most funds would be. So you have that inbuilt protection. The funds come with that wire that you're talking around about the outside. So really, they're built to be more robust than something that invests in a single market or a single investment inherently. So that's a really good starting point to have. My worry is that you can, if you're not careful, and you're not looking deeply and understanding really truly what you own, that you can have things that you think are spreading risk across different things, but actually might give you the same exposure, but just in a different way. So you might be very sensitive to something that you haven't spotted. And I'll give you an example in the market at the moment, which is artificial intelligence. I think most people would think to themselves, artificial intelligence, in some ways is a threat maybe to jobs and so on, but I suspect most people agree that it's probably going to be a great thing in some ways for the world in terms of productivity, a bit like the internet was a few years ago, and probably in some ways maybe something they want to have some access to in their investment portfolio. And some people might think, well, what would I invest in to get access to that? I might invest in those large US technology companies, the ones that many of us use, like Apple. There's obviously Nvidia, which makes microchips, which obviously plays into that theme, and of course Alphabet and those types of companies. And maybe you think that if I've got a portfolio with those, and maybe that's the only place I'm really getting my artificial intelligence exposure. But you could also get artificial intelligence exposure if you have a big weight in Asian stock markets, particularly Korea and Taiwan, because they're dominated by companies that are highly reliant on the success of the artificial intelligence theme. And then in the real estate sector, you have things like data centers. And the growth of data centers, of course, again, is highly tuned in to how well or badly the artificial intelligence theme does. So it's actually a one theme, but spread across different parts of the market. And if that theme is something that falls out of favor with investors or doesn't do as well as thought, it can actually affect more than one part of the market. So one of the key risks I'm trying to look out for is, do we have a blind spot anywhere where we're exposed in more than one way to a theme that we might not fully realize at first? And I think that's probably the key risk in the type of portfolio that I manage, that we try and keep an eye out for. But as I would say, as I did at the beginning of that, the great thing about a multi-asset portfolio is that it's inherently more of a sleep at night portfolio because it is so broadly spread across different things.
There is, in the past, there's been a view of fund managers that there is the star fund manager who's picking out stocks and is making money for their clients, and you should be with that star fund manager. And I guess the shine's come off that view to a certain extent over the last few years. And there is a growing voice that says, you can't beat the markets, so therefore just invest in everything. And then you get into the debate around active investing, where the fund manager is attempting to beat the market, and then passive investing, where you're just attempting to own the market. How do you, as a fund manager, see that debate? Are you specifically thinking, you know what, I can beat this market, or is it much more nuanced than that?
It is certainly much more nuanced than that, and I can tell you, in my household, there's no danger of me thinking I'm a star or anything. I'll soon be brought back down to earth pretty quickly. But you're right. I think the industry, in some regards, has in the past had sort of star managers, and I think humans kind of to some degree buy other humans, don't they? People buy people, and people buy stories, and they're often good stories. And even today, like people like Warren Buffett are famed as great investors, and a lot of people kind of go to. He's got a conference every year that thousands of people go to. So you can kind of see why that star manager kind of narrative is quite attractive to some folks. But I think it is much more nuanced than that. There are lots of active funds out there, and some are much better than others. It's probably true that in a lot of markets, the average active fund doesn't outperform the market, but there are some areas of the markets where the opposite is true, that they do. I actually don't believe in passive investing. And I'm not saying that because I'm an active manager. What I mean by that is whether you're using active instruments or active investments, I should say, like an active fund, or you're using a passive investment, like a passive fund or a passive ETF, I actually think you should be using them actively. You shouldn't just buy them and totally forget them. Although I do say that you shouldn't be looking at that stuff too often or moving it around too often. But sometimes markets can become very, very concentrated. A really good example of that was in the late 1980s, early 1990s. Japan made up around 40% of the global stock market. So if you bought a global passive investment, global stock market passive investment, you'd have had around 40% in Japan. And actually the biggest part of that was Japanese banks. And you probably didn't want to, in hindsight at least, be over-invested in that particular part of the market. So I think passive investments are great. I think they've democratized investing to a degree, allow you to get broad market exposure, and actually quite nuanced exposure in some cases. You can do some quite interesting things with tracker funds and ETFs. But I do think we have to keep an eye on those for when markets change over time, or they might become too concentrated. So I believe even when we're using passive investments, we should be using them actively. And I don't think we should be relying on anybody to be super clever and be, the one person who's somehow a sage and going to beat the market repeatedly over time. You think back to, I can't remember the exact number, but I'm sure Roger Federer did a kind of university commencement or maybe end of year address over the last year or two. And I think he said, and he's probably top 3 tennis player of all time, to some people the best. And I think he said he won 52 or 53% of his points, to become the best. And I think it's pretty similar in our world. Is if you have a strike rate like that, you're doing pretty well. The best thing to do if you are choosing an active manager is to make sure they have a really robust process, that you really understand what they think about markets and how they're going to put that belief into practice, and they're supported by a really strong team and infrastructure around them.
Played tennis myself last night, and I definitely lost more than 50% of my points.
At least you got to the ball. I don't think I'd get to the ball as quickly these days myself.
Yeah. Right. In order to finish off, what I thought we'd do is we'd get the fund manager's view of some top jargon and try and demystify it for the end consumers. And I'll caveat this by saying, on Funkled, you can go on and we've got modules, we've got videos and interactive learning materials on all of these topics.
Okay.
So you can go and get stuck in to learning what about all of them are. But just for the sake of today's podcast and the listeners who are getting stuck in here, let's take a few of the big key terms and see if we can break them down into the really simplest bare bones. So stuff that people hear all the time around funds and investing. Let's get the fund manager's view of what they actually mean in reality. Diversification.
Okay, diversification. I suppose the simplest way of describing it is basically just not putting all your eggs in one basket, not putting all your money in one place. You spread it so that no single investment or mistake crisis can basically sink your portfolio. And back to that allotment analogy, don't put all your money on that prize tomato plant. Spread it across you have a basket of vegetables of different types.
Okay. Correlation.
I suppose that's how, to what degree investments move together in a synchronized way. Think of those synchronized swimmers in a pool. If they're all doing the same thing at the same time, then when the world isn't going well, they're all probably going to do badly at the same time. So one of the tough psychological things, both for professional fund managers like myself and any real investor, quite frankly, is that we all want our investments to do well all the time. But actually, the reality is if they're all doing well at the same time, we probably haven't built a very good or very robust portfolio, because when things go badly, we need something to help offset some of that.
Yeah. We've already touched on volatility. And we've touched on active and passive, so we can skip those because we've delved into those. What about fund of funds? As you hear about fund managers running a fund, but then there's a fund of funds.
Right, so the fund managers running a fund will typically be buying what we call single securities or single investments, like shares in a particular company. Let's say, let's pick a UK company like Rolls-Royce or something like that. And then they'll be doing that with a number of companies to build a fund. What a fund of funds is a fund of a collection of those funds. So the fund of funds that I run, for example, will typically have about 20 to 25 underlying funds and ETFs within them. So you've already got a fund is something that's diversified or spread across many different investments, and a fund of funds is probably more diversified still, or the risk is spread even further because you're buying, a collection of collections, really.
So your job as a fund of fund manager is actually not to research those underlying companies and those underlying bonds and stocks, etc. Your job is to research the other fund managers and work out who's doing a good job there and how you pull all of those guys together.
Exactly that. So, and also where we use an active fund manager and where we think, actually, we just want the broad market exposure here. So when I look around the world, I think, right, where do we want to be active? To your point, to use an active fund manager, and where we do want to be active, we want to work out which fund managers we want to use to access that part of the market, and then where do we want to be passive and why, and how we're going to access that. And what I would say is that very rarely do we just choose one fund manager for one part of the market. We normally pair a couple together, and it's normally because they're doing different things at different times. Hopefully, over the long term, they both give us a good results, but we get that inherent spread of risk between at least a couple of different fund managers in the UK and in different markets around the world as well.
Now, this isn't back on the allotment analogy, but what is generally meant when people are talking about hedging?
Okay, yeah, it's certainly not trimming the hedges around your allotment. I think when people say, well, you can hedge different things, but ultimately hedging is about reducing risk in your portfolio where you can, and you can hedge against various things. One of the things you can hedge against is falls in the markets. And you can pay. It's effectively like an insurance policy. Is probably the best way to describe it in terms of what people will be used to. There's a premium you have to pay for an insurance policy, and in an ideal world, it never has to pay out. But as we know, markets do fall at times, and houses do get burgled, and cars do get damaged. And so when that happens, it's sometimes in markets there are things that you can put in place to help dampen the downside.
Excellent. Look, this has been fascinating. I ask everybody who comes on the Funkle Pod the same question in closing, which is, what do you know now about money that you wish you'd known sooner in life?
Well, that's a good question. And I actually grew up in a household with relatively little money. So I grew up in a fairly low income household with a single parent. So money was fairly tight. So the idea of investing to us at the time was, it was probably a jar in the kitchen to keep some aside, or maybe premium bonds. And we didn't really know much about the world of investing. So I'm going to give you a couple of answers if you don't mind. The first one would be, I wish I'd known what investing was and the power of investing, and particularly the power of compounding over time. I think Einstein called it the eighth wonder of the world, and it is super powerful. And related to that, more recently, I think people have been speaking, it's a long-held concept, of the power of 72. And I think the power of 72 is really, really interesting because you can take a return that you might be expecting, divide 72 by that return, and it will tell you how long it will take for your money to double. And it's quite an interesting exercise. So you can say, for example, that 7.2% a year annual return. It will take you 10 years for your pot of money to double, assume you reinvest it as you go along. And I think that's really, really important. And I'm going to butcher a quote here, but I'm sure somebody said something like, the best time to plant a tree was 10 years ago and the second best time is today. I wish I'd known that as well. So all of that, really, all those three different answers are about the power of compounding your money over time. There's a thing that hadn't existed for quite a while for most of the last 20 years, and it's been back in the last few years, called inflation. Of course, that erodes the value of your money in real terms over time, what you can buy with the same amount of money, and that compounding is a key protection against that over time.
My biggest takeaway from this is that fund management isn't at all like people might think it is from the movies. It's not about constant action and clever moves. It's about having a clear process, making deliberate decisions, and then sticking to them over time when things get uncomfortable. And that is almost exactly what we should all try and do with our finances and our approach to money. Less emotional, less reactive, focused on the long term. The planning tools in Funkled can help you make some key decisions before any emotion takes over. For example, the budget planner to set some clear savings and investment goals, learning modules that go deeper into understanding some of the topics we've talked about today. Not just what a fund is, but taking all the jargon out of what bonds are, gilts are, what active and passive investing is, sustainable investing, and more. So if today helped demystify what happens to your money behind the scenes and what a fund manager gets up to, and you want more of this, well, please do like and subscribe to the pod. Make sure you get signed up on the site for the learning modules. Remember, we don't provide financial advice. We're a financial education platform, but the idea here is to help you make better financial choices, understand things. So if you are thinking about investing, if you already are investing, or you know somebody who is, please feel free to like and share this episode. And if you need to, remember, get Funkled. Thank you very much, David.
Thanks, Dan. Really enjoyed that.
Cheers.